Hello, everyone, and welcome to today's SALTrends webinar about how recent tax legislation will impact you and your business, sponsored by GBQ Partners, LLC. Today's presenters are GBQ's State and Local Tax Services Director, Sarah Goldhart, and Manager John Petzinger. Now I'll turn the call over to our presenters to start today's presentation.
All right, thank you, Trish, and thanks everybody for joining us today. I know we have a lot of people on the call today. There's a lot of hot topics that we're going to be talking about today, so appreciate everybody's time. Just a couple of housekeeping items, just our general notes about the presentation before we get started. As Trish mentioned, I'm Sarah Goldhart, State and Local Tax Partner here at GBQ. I'm joined today by my colleague, John Petzinger, who's a manager in our state and local team. And some of the things that we're going to be covering today are included on our discussion topics page, the Ohio biennial budget bill, which is a very hot topic at the moment as Ohio tries to finalize its budget by the end of this month. So John's going to be taking us through the different aspects of the budget, where it's at, what's in there from a tax perspective, and where we're headed, again, kind of before that deadline at the end of the month. I'm going to be covering some multi-state legislative updates just to give you an idea of things that are going on outside of Ohio. Definitely, this is budget season in a lot of states, not just Ohio. So we've seen the passing of a lot of other state budget bills with a lot of tax implications in it. There's also legislation, obviously, at the federal level, which you've been hearing a lot about in the news. And we're going to talk a little bit about a couple specific provisions in that federal legislation that may have a SALT impact. Most importantly, the SALT cap, the status of that, which impacts the elective pass-through entity taxes, and also Public Law 86-272. There's something in the federal bill that addresses that provision. I'm going to talk a little bit about some of the employment tax updates that we're seeing and just address a couple of quick tax credit updates. And then lastly, John will close it out with some legislative trends, just to recap the things that we're seeing in general from a lot of states, where we're not going to get into all the specific updates. There is a lot to cover. We're going to touch upon a lot of different things, different states, different tax types, entity types. I know we usually get a mix on here of folks that may be just Ohio, whose businesses may be just Ohio, or they're located only in Ohio, to those that are multi-state. So we're going to cover a lot of different areas. But if you hear a specific state or maybe a specific tax type that you're more interested in, or that your business is doing a considerable amount of work in and have follow-ups, feel free to reach out to myself or John as well. And before we get started, before John gets started with Ohio, we'll do our first polling question for CPE. How often does Ohio pass a budget bill? So if everybody could go ahead, you should see the poll pop up for that. Oh, there we go. Annual, biennial, decennially, 10 years. There is one state that's decennially. Seconds. Get everybody? Okay. All right. It is biennially is the answer, and I'm going to now turn it over to John, who's going to talk about that biennial budget bill and where things stand. John?
Thank you, Sarah. So this is Ohio budget season. The current fiscal biennium expires on June 30th. So state of Ohio is looking to get a new budget in place by July 1st. They're working to that. You will see on the slide here, it says Senate Finance Committee proposal current through June 11th. There was quite a bit of activity on the budget bill last week. So I believe this presentation should cover everything up through current, notwithstanding that date that's set forth right there. So the original administration proposal from Governor DeWine and the House House passed budget were fairly tame, but in the Senate, they have added a proposal to move Ohio to a flat rate personal income tax. Under current law 2025, there would still be two rates. The top rate would go from 3.5% to 3.125% on income over exceeding 100,000. And then for 26, the rate would be 275 on all income. So taking a step back and looking at how Ohio got here, if you look back to 2004, immediately before the corporate income tax was phased out, personal property tax was phased out on most taxpayers, and the CAT was enacted. Those all took place in 2005 budget bill. Immediately before that, Ohio had 9 brackets, the income tax, and the top rate was 7.5%. Fast forward 6 years to 2010, you still had 9 brackets, but the top rate was down to 6.24%. A few more years, 2015, we've moved the top bracket just under 5% at 4.997. Starting in 2017, we started to see a decrease in the number of brackets from 7 to 5 to 3, and now currently where we sit at 2 brackets. So it's been a 20-year process to go from where we were at 9 brackets and 7.5% to see how it plays out, perhaps to 1 bracket at 2.75%. One interesting nugget about the Senate bill is it did not change the tax rate on business income, which would remain at 3%. Of course, after the business income deduction of $250,000. So that's kind of the headliner, if you will, on the Senate bill right now. The bill would also eliminate a longstanding provision, again, kind of going back to 2004, 2005 timeframe, that allowed pre-income tax trusts to elect whether to be subject to income tax or CAT. This proposal would move all pre-income tax trusts to income tax only. Before moving to the next slide, I guess without getting too deep into budget economics and all that, just high level, the state has scored the tax cuts for 2026 at about $529 million, and for 2027 to about $1.1 billion. So I'll throw a few numbers on some of these things just for perspective. The pre-income tax trust provision, the state has scored like $7 million. So that's a fairly targeted cut. On to the next slide. A couple other changes. The Senate would disallow the personal, spousal, and dependent exemptions in the joint filing credit when taxpayers have income exceeding $500,000 in 2026 or $750 in 2025. One provision that did come back in on the Senate final version, passed late last week, would allow tiered pass-through entities and their owners to more efficiently claim credits for PTET paid by lower tiers. What this would allow is when you have tiered entity structure of S corps, partnerships, and so forth, under current law, the credit for lower tiers is not available. That credit's only available on a composite return or on personal returns. So there can be situations where tiered pass-throughs kind of are at a disadvantage in being able to obtain those federal benefits. So the proposal here would fix that in some situations. Next slide, please. Also, the Senate bill would make a number of changes to sales tax provisions, including a number of exemptions. We've seen this kind of dynamic before. If you go back about 10 years to one of Governor Kasich's proposals in a budget bill, again, income tax cuts with the General Assembly looking to offset the revenue effects and to kind of structurally change the balance between income and consumption taxes by eliminating exemptions or other sales tax provisions to help offset the revenue loss from the income tax changes. The changes proposed here by the Senate are a bit more targeted than they have been in the past, and it's certainly not a full offset. I don't think that's the General Assembly's intent. But we've got a couple slides here with some of the sales tax provisions that are in the Senate bill. Kind of going through the bullets here. direct pay permit refunds. There'd be no interest on those. There'd be an elimination of interest on refunds of the county tax portion of refunds, which interestingly, that's not really a state GRF issue right there. And that's one that the Legislative Service Commission, I think, scored this as minimal county revenue impact. Big one here, the third bullet would cap the prompt pay vendor discount at $750 per license per month. The current discount is 0.75% of the tax due. In the latest Senate amendments, they did remove that cap for for auto sales. So the cap would apply to non-auto sales, and the revenue impact of that provision itself, I think, is estimated at 10 million for the current or for the 2026, and then 20 million for 2027, and the difference there being the effective date of 1/1/26. The bill would also repeal the 25% refund of tax provided to electronic information service providers. And another potentially big one here would prohibit the Ohio Tax Credit Authority from awarding further tax exemptions relating to computer data centers beginning here on October 1st. Next slide, please. The total overall revenue gain from all of these sales tax provisions for fiscal year 26 is estimated at about 100 million, and for fiscal 27 at about 200 million. So roughly 300 million compared to the figures on the income tax, which were about 1.6 billion. Again, these aren't supposed to fully offset the income tax revenue losses. A few more sales tax provisions here would repeal certain exemptions for sales and purchases of the following: newspapers, car rental payments while the owner's having their car repaired when the service provider reimburses, transfer of copyrighted motion pictures, refrigerated food vending machines, and items purchased by a direct marketing vendor to be used in printing advertising materials, and their equipment that's used to accept orders. Next slide, please. A few more: machinery, equipment, and material used in the production of printed material. The original Senate Finance Committee proposal would also have eliminated the exemption for agricultural land tile and portable grain bins. This particular one did get restored by the Senate late last week, so that's why it's crossed out there. The Senate bill would also remove the exemption for telecommunication services used to perform call center functions, and also sales of any TPP used to acquire, format, edit, store, or disseminate data or information by electronic publishing. So yeah, a number of sales tax proposals there, pretty targeted. So we'll see what happens with those as the bill works its way towards the governor's desk. There has been a lot in the news also about Ohio property taxes and school funding, and we're not going to do a deep dive on those here in this presentation. Anybody that's worked in that area, you understand that that's probably a whole presentation of its own, maybe two. There's a lot there, and it's a very complex formula on the tax side and on the school funding side. But the takeaway here is there are a lot of proposals, both in this bill and in separate bills, that the legislature is considering. There's been considerable testimony, proponent and opponent, on all these issues. So it'll be interesting to see how this plays out in the next few weeks, whether a lot of this gets rolled into the budget, or whether some of this may continue on into the next session for consideration. But a few bullets here just to make everyone aware of. The current Senate bill would eliminate the authority of political subdivisions to levy replacement levies. It would also prohibit school districts from submitting levies that are renewals and increases, as well as a couple other types of levies. And there's a uh, there was a proposal in the House version of the budget that would require a county budget commission to reduce school district property tax levies if the district's operating budget carryover exceeds 30%. So essentially, if a district is carrying a cash balance that exceeds 30% of their expenditures, the House proposal would allow the county to reduce the property tax rates to account for that excess over 30%. The Senate proposal, the Senate bill, increased that 30% to 50%. So it measured against a 50% carryover. So again, that's just a few pieces of what's in the bill currently. I know there's a lot of other discussion, so stay tuned on this piece of the budget for sure. Slide. Yeah, I guess. How often do you, next CPE question, how often do you read about the progress of the Ohio budget bill? A, daily, B, weekly, C, every couple weeks, or D, you're not following, just wait until it's final.
Waiting till GBQ puts out that final summary in July.
There we go.
I think that is the response. Waiting until haven't followed, waiting until it's final, and every couple weeks. So we will be obviously following what happens now with in the reconciling of the final bill as it heads to DeWine, Governor DeWine, for signature at the end of the month. So we'll be putting out more updates on that. And once it's final, and then the governor also usually has the chance to veto any items. So so in July, we'll be putting out more the final information on where these things land from a tax perspective. Now we're going to talk a little bit about states other than Ohio and some of the things that we're seeing, some other states that have passed budget bills or some significant legislation here. This is just in 2025, since January. A few states to highlight. Arkansas is one that had Senate Bill 567, which enacted some significant changes for those companies that are doing business in the state of Arkansas. They moved to what is called market-based sourcing for receipts other than sales of tangible personal property. So this applies if you are a multi-state business and you are doing state apportionment and you're a service provider or the seller of intangibles. The sourcing of those sales for apportionment purposes will now be market-based as opposed to cost of performance sourcing. So now the state is looking to where the benefit of the service is received, where the market is, where that service is received, as opposed to cost of performance, which looks at where the service is performed. So this can cause a major change in your apportionment percentage. If you are an in Arkansas in-state company, or if you're a company that doesn't maybe have a physical presence in Arkansas but does a lot of sales into the state, you'll definitely want to take a look. If you're a service provider or seller of intangibles, you'll want to take a look at your sourcing there. Another item in Arkansas is they adopted a bright line economic nexus provision. So any business without a physical presence in Arkansas is excluded from income tax if its gross receipts in Arkansas is less than $250,000. So that economic nexus provision applies to both corporations and partnerships. So if you're under 250,000, you will be excluded from income tax. If you're over, essentially that would create economic nexus. So something again, and then with the switch to market-based sourcing, which those two things usually go hand in hand, is the market-based sourcing and economic nexus you'll want to take a look at if you have significant business in Arkansas, but potentially, are not filing there currently. The Arkansas, that Senate bill also continues to phase out what's called the throwback rule in Arkansas. Again, this relates to apportionment and calculating your apportionment percentage. That continues to get phased out, but it does adopt a new throw out rule, which essentially removes certain receipts from the numerator and denominator of your sales factor. So again, something to consider. And they've also made some adjustments to the definitions of business and non-business income. So you definitely, if you have a lot of activity in Arkansas, you'll want to take a look whether you're a corp or a partnership at some of those items to see how your business will be impacted. Illinois also enacted some pretty significant legislation, House Bill 2755. Some highlights of that bill: there was no change to the rates. That's one thing, though, that we don't have on the slide, but want to highlight. There was no rate changes in Illinois, but it did make some other changes. One, if you are a C corporation, a group, a consolidated, combined group of C corporations, they have now adopted the Finnegan rule, effective for tax years ending on or after December 31st of 25. If you're familiar with, if you're in the C Corp space, there's Joyce and Finnegan. Finnegan basically pulls in all the sales from all the members of a group, whether they have nexus with the state of Illinois or not. So this could be something that could have a significant impact on your business. Again, in that if you're a consolidated group of C corporations with multiple entities in the group that have activity in Illinois. They also made some changes around the GILTI, which is a foreign tax provision, and the intangible expense add back provisions. The GILTI dividends received deduction was modified, and then the interest and intangible expense add back provisions. There's also some modifies the current law regarding allocation of non-business gain loss from the sale of a pass-through entity. That's always an area that can be pretty complicated, is when you're dealing with the sale of a pass-through entity interest. So just some things to note. I'm not going to get into the details of those modifications, but if you have those items, you'll definitely want to take a look. And then it creates a tax amnesty program. There's actually 3 separate amnesty programs, but the general amnesty for most tax types will be later this year in October, and from October 1st to November 15th. So it's something that you'd want to keep in mind if you think you have some outstanding liabilities with the state of Illinois. It's a way to come forward, and the state will give you some forgiveness on the, I believe, penalties and interest. Something we always like to mention whenever a state does establish an amnesty program is to don't forget, though, that most states do have a voluntary disclosure program as well that's in place. Illinois is one of those. That is also a mechanism to be able to come forward voluntarily if you have outstanding liabilities. Sometimes the terms of the amnesty program are a little bit more generous in that they abate interest as well, but a voluntary disclosure often allows you to limit the look back period at how far back you have to go, whereas amnesty usually does not. So just something to remember if the sound of the amnesty piques your interest in Illinois later this year, just remember you'd want to look at both the amnesty and the voluntary disclosure to see which one is more beneficial for your company or for you. Kansas had House Bill 2231. Again, we've got some of the highlights of the things that were included in that bill. Kansas will be adopting single sales factor apportionment beginning in tax year 2027. I think this was an interesting kind of fact, is that Kansas was one of only about 6 states still using equally weighted 3-factor apportionment. So that used to be the standard for most states, was equally weighted 3-factor, and now with Kansas moving to single sales, there's only about a handful left that will be using equally weighted 3-factor. So that's in 2027. They've also moved to market-based sourcing, which I just mentioned for Arkansas as well. Kansas moving to market-based sourcing for receipts, again, on sales other than tangible personal property. And the bill did allow for future corporate rate reductions, which is something we'll talk a little bit about later in the trends that we're seeing overall in all of these bills. Maryland, House Bill 352, they actually increased the top marginal rate for individuals with AGI over 300, top marginal rate for individuals to 6.5%. They've also imposed a net capital gains surtax for individuals that have AGI exceeding 350,000. So some additional ways that Maryland is looking to raise revenue for the state by imposing that surtax and raising that top rate. Notably, something that was not in the bill that was almost more notable than some of the things in it was the bill failed to implement mandatory combined reporting for corporations, meaning that corporations would have been required to file as one group instead of separately. This is something that Maryland has been looking at for a long time now, and again, failed to get there. So again, if you are a consolidated C corporation group or have a combined group, this is something to note that Maryland for now will continue to be a separate reporting state. A few other things, states to highlight of interest. Massachusetts clarified that for tax years beginning on or after 1/1/25, the apportionment methodology for pass-through entities will be single sales factor apportionment. This matches the change to the corporate law as well. Corporations now will be single sales factor apportionment. Massachusetts was one that was a long-standing three-factor state, moving to single sales. And this kind of highlights an issue that we see sometimes in state taxes, making sure you understand the apportionment methodology for both corporations and pass-through entities to make sure that they're the same. A lot of what we hear from states is around corporations. This particular provision clarified on pass-through entities, but there are still a few states where the apportionment method for a pass-through entity is different than a corporation. So something to be aware of there. In Michigan, House Bill 5022 amended the date by which to make the elective PTET election. It was the 15th day of the third month of the year, so was March 15th. That has moved to essentially, if your calendar year, September 30th, the last day of the 9th month of the year. So gives companies, pass-through entities, extra time to make that pass-through entity tax election for the year. So that is something to note. Nebraska, they made a tweak to their PTET annual election, saying that you can make it on a timely filed return. The separate filing of the PTET-E is no longer required. And something to note in Washington, I know we have more and more clients who are selling into Washington, who are subject to the Washington Business and Occupation Tax, which is the gross receipts tax in Washington. It has a very low nexus threshold of only $100,000 of sales into Washington. House Bill 2081, it is going to increase the rates for several of the tax classifications under the B&O. So, and that includes manufacturing and wholesaling and retailing, which are classifications that I know we have a lot of clients that fall under. So that is definitely something to be aware of, that those rates will be going up for both of those classifications. So there were some other states that also had some updates. We're just going to summarize kind of at the end some of the trends that we've seen. There would be too many to cover today, but definitely a lot of activity right now from a multi-state perspective, and states, making changes to their kind of tax regimes. And then not only at the federal or at the SALT level, at the state level, but we're also seeing some legislation at the federal level that we wanted to highlight. Even though it's federal legislation, It involves the SALT cap, which has had a significant impact, obviously, on state and local taxes. Always like to do a brief recap of the SALT cap just to make sure if there's anybody at this point that hasn't heard of it. But the SALT cap started back in 2017 under the Federal Tax Cuts and Jobs Act and essentially capped the itemized deduction for state and local taxes at $10,000, $5,000 for married filing separately, and so capped it at $10,000. Once that happened, it has set off a chain of events. From legislation, we saw several states challenge the SALT cap in federal court, but were unsuccessful. And then we saw the development of the elective pass-through entity taxes. So in retaliation or in response to the SALT cap, we've seen over the years 36 states that have enacted an elective pass-through entity tax to essentially allow business owners to take advantage of, and I'm going to go back, I skipped a slide, take advantage of IRS Notice 2020-75, which essentially said that you could move or kind of shift the deduction of the income tax that from the individual to the entity. So it essentially made the taxes paid by the S corps or partnerships to the entity itself where they could be fully deductible. And in IRS Notice 2020-75, the IRS essentially kind of signed off on this method, and since then, that's when that 36 states, kind of one after the other, implemented their own versions of these elective pass-through entity taxes. The SALT cap, I think importantly, that last bullet, the SALT cap is currently set to expire at the end of 2025. So, states, we were already anticipating what was going to happen this year. There are some states where the elective pass-through entity tax is set to end also at the end of the year. Some do not, so it's kind of a mix, and it's really going to depend on what happens at the federal level. There are the 36 states, again, that have enacted an elective pass-through entity tax. Every state with a tax except those handful that are listed there, Pennsylvania being kind of the biggest and the one just given proximity to the state that we get asked about the most. All of these are a little bit different. Each of the states, their elective pass-through entity tax regimes have all been a little bit different. So, it's been significant amount of work since this was enacted, and since a lot of these were enacted, to track them all, help businesses understand them. Businesses have taken a look at which ones most benefit them, and so it's been something that has been a significant amount of work by the states as well to initiate these regimes. So what we're seeing then in terms of the federal legislation is in the One Big Beautiful bill, which is probably something that you've been hearing about, the federal legislation. The House bill that was passed on May 22nd would increase the SALT cap then to $40,000 from the $10,000. Currently, it's $40,000 for married filing jointly, and then it would phase the cap back down to $10,000 for married filing jointly, with modified adjusted gross income of $505 to $605, and then it would increase the cap by 1% each year for 7 years, starting in 2027. So progress there in terms of an increase in the SALT cap amount, which would likely help a lot of taxpayers, to see that number go up from 10 to 40,000. So that is something, obviously, that we're watching to see. There's been a lot of debate over that number and where it's going to land, and would have a big impact then on the states, and whether businesses, pass-through entity owners will still want to elect in the pass-through entity taxes if still able to. One other provision to call out, the House bill passed on May 22nd, however, would deny a SALT deduction to individuals claiming the PTIT if the partnership or S Corp is a specified service, trade, or business. So if it's excluded from IRC, the 199A treatment, and we've got them listed there, most notably health, law, and accounting, performing arts, financial services, anything where the principal asset is the reputation or skill of one or more of its employees. Essentially, the individual owners of those types of businesses would essentially not be able to claim the PTET deduction. So in effect, the bill would reinstate that SALT cap at 40,000 subject to phase out for owners of an SSTB. So this is something that we've been hearing a lot about. We're specifically tracking, especially we have a lot of clients who fall under this specific treatment. So it is a provision that we're watching closely as this federal bill continues on. We have our next polling question, our next CPE polling question. The following is true about Public Law 86-272. And that's going to be our segue into our next section on Public Law 86-272. We've got three choices and then the infamous all of the above. Okay, just a few more seconds. Look like everybody knows that's all of the above on that one is the correct answer. Okay, I'm going to turn it back over to John. Who's going to mention that there's some Public Law 86-272 language in the federal bill, which has been surprising. And there's always talk about 86-272. So, again, while it's federal bill, this provision impacts state and local tax similar to the SALT cap. So, John, you want to talk a little bit about 86-272 and what's going on there?
So Public Law 86-272, as it says in B there, it's a federal law. It has been law since 1959, so we're talking about 65 years this law has been around and hasn't been substantially altered since then. It prohibits a state from imposing a net income tax on an out-of-state company if the activities are in the state are limited to the solicitation of orders, key phrase there, for the sale of tangible personal property, and if the orders are approved, they're approved and filled from outside of the state. A couple notes. This only protects a company from only state income tax. So, for example, franchise taxes on net worth or gross receipts type taxes, 86-272 would not apply there and does not protect. So over the 65 years this law has been around, as you might imagine, a number of states, aren't real fond of the law because it limits their ability to collect revenue and to tax businesses that, in their view at least, are doing business in the state. That being said, there's been very little momentum in Congress over the years to amend this law or to eliminate it. But it's kind of an odd situation in that it's a federal law regulating states' taxing powers, but it essentially gets administered by the states themselves. Certainly, decisions of state courts are appealable to the U.S. Supreme Court, but there's only been a couple cases over the years that have really, been accepted by the Supreme Court and provided any light, shed any light on the meaning of these key provisions. The states, along with the Multi-State Tax Commission, have continued over the years to try to, whittle away, chip away at the protections of 86-272 through audits, through regulations, administrative pronouncements, and of course litigation in state courts. The Multi-State Tax Commission in particular, I know we've talked about this on some of our other SALTrends webinars, the MTC has a statement that's been out there for a number of years, kind of their interpretation of what 86272 protects and does not protect. And a couple years ago, the MTC updated their statement to address activities undertaken over the internet. And that's proven to be fairly controversial. The MTC and the state's view, they kind of look at it as, well, the economy and the way companies do business has changed a lot since 1959. So we need to update our interpretations and figure out how this applies to new types of business activity. The updated statement addresses various internet website features and provides the MTC's opinion on whether companies with those types of websites are protected with respect to their state net income tax. And there's been a few states that have come out and said that they like that guidance, that they would like to adopt it, that they will be enforcing it, that it's their new interpretation. Again, we've discussed in prior webinars, California, they actually put out a notice adopting many of those MTC provisions, but California court struck that down. So that's kind of in limbo right now, although California certainly showed the way they, the way they view the law. Similarly, in New York, well, a little bit different in New York, New Jersey, and Massachusetts, those states have introduced administrative regulations through their DOR to adopt, if not the whole MTC statement, certainly pieces of it, and the general, the general gist of it being that these internet activities can exceed the protections of PL 86272. In particular, the statement looks at, does the website have an interactive chat feature? Does the website leave cookies on a user's computer? And what do those cookies do? Some cookies are okay and won't cost you the protection in their view. Other cookies, depending on how they're used, may, again, in the MTC and the state's views, cause the company to lose that protection. It's important to keep in mind when looking at the MTC regs or statement and looking at articles discussing these, you always have to remind. I always have to remind myself, that these MTC regs are simply the state's view. Until a state adopts regulations or changes their law, the MTC statement is not law. It's just a statement of their viewpoint. So that's the background. So going to the one big beautiful bill, this bill has language in it right now that would expand the protections under 86272. And I have in italics here what that language says. It says the term solicitation of orders means any business activity that facilitates the solicitation of orders, even if that activity may also serve some independently valuable business function apart from solicitation. Those are a lot of big words there. So what's it really getting at? Well, I think big picture, it's definitely an expansion of the protected activities. If you go back to the Wrigley Supreme Court case, this is in the U.S. Supreme Court from the early 90s. Again, one of the few cases where we have some guidance on 86272 from the Supreme Court. In that case, the Supreme Court said the solicitation of orders includes activities that are entirely ancillary to requests for purchases. Those activities that serve no independent business function apart from their connection to the solicitation of orders. So in this case, for example, providing a salesman with a car and samples, recruiting and training salespeople. For example, Wrigley had salespeople in the state of Wisconsin that were soliciting orders for sales of gum that were shipped from out of state. And the court looked at some of these things and said, the way I characterize it as kind of like, well, these people have this, the sales activity includes certain things other than simply, the the actual request for purchases from potential customers. Giving a salesman a car so he can go out and visit potential customers and make those requests. Those are the kind of things that are protected activities. The court looked at some other activities and said, no, that's not solicitation of orders. And this includes activities that are, solicitation of orders does not include activities that may be routinely or closely associated with solicitation or the types of activities performed by a salesperson. But these are the types of activities that a company would have reason to engage in anyway in the state, even if they weren't soliciting orders. So in the Wrigley case, for example, having a salesperson repair or service a customer's product, replacing stale product. In this particular case, the gum salesmen that were selling gum and other confections would carry a supply of fresh gum. And if for example, they came to a retailer that maybe XYZ brand had been sitting for a while and gotten stale, well, the salesman replacing that with fresh product, the court viewed that as sort of outside the realm of solicitation of orders. So coming back to the language here in the federal bill, it clearly would expand. When a little personal observation, when I look at this, this is still, this is pretty wordy. This is pretty technical. And kind of given the lack of case law in this area, I kind of question how helpful this will be. While it certainly is helpful in regards to taxpayers with certain fact patterns, this may if passed as is, there's still a lot to question about. Well, what exactly is an independent valuable function? What types of activities may facilitate solicitation but have an independent purpose? So while it's certainly potentially beneficial, there would certainly, it wouldn't remove all ambiguity here, or we wouldn't see an end to PL 86272 litigation or audits, but it certainly would change the rules a little bit, and would be interesting to see the guidance that comes out from states, from the MTC, and from other SALT experts and commentators as to the extent that this would be helpful and what it would cover. So stay tuned on this. We'll see whether this ends up being part of the final big beautiful bill when that becomes final. I'll pass it over to Sarah for some updates here on employment tax and related tax credits.
Thanks, John. And yeah, I would just add, I agree. While it's some changes proposed there to 86272 is definitely not going to be the end as far as it being somewhat gray and being able to kind of refute positions and discussion around different positions and things will definitely continue, but we'll see what happens with that bill. But that's a law that's critical to a lot of our clients that continue to solely sell tangible personal property. So it's something that we'll be watching and definitely putting information out on as it progresses. We have a few minutes left here today, so I just wanted to highlight some things on the employment tax front. We have been mainly highlighting just the income tax side of things, income and employment. I know we mentioned a few things in the Ohio segment on sales and property tax. A lot of these bills that we're talking about have had some sales tax implications as well. We generally leave that to our colleagues. There'll be more information on those things as well, or reach out up to me or John. We definitely can bring in our colleagues who handle the indirect tax, but there's definitely some things on that side too to consider. But today, honing in on the income tax and employment tax updates, just a few things. The first bullet there, I just want to highlight because this is something I work with a lot of clients on and continue to get a lot of questions on. The work opportunity tax credit and the empowerment zone credits. Those are still set to expire at the end of this year, December 31st of 25. So there's nothing in the big beautiful bill about it. We're monitoring though. In the past there have been extenders. We've seen these credits set to expire, and there's been extenders. So we'll continue to monitor these because I know we have a number of clients that claim both of those credits and are very valuable to their business. In regards to that one big beautiful bill, there are various employment tax provisions in there. So it's definitely something you'll want to look at from a federal perspective. One of the big things being the TIPS provisions that you've been hearing about in the news. And so we'll be putting out some information on that on the federal side too, as that bill, again, as it continues to progress. A couple of things I wanted to highlight from a state and local perspective. The continued movement towards trying to simplify withholding for companies, employers that have employees who travel across state lines. There's a federal bill again that's been introduced, which the Senate Bill 1443. There's been a federal bill pretty much, I think, almost every year a federal bill gets introduced, but it just hasn't had the movement to go anywhere. But would basically try to streamline tax compliance for employers with traveling employees. It's always been in the previous bills, and then the latest is the 30 days has been the threshold where if you have employees traveling into a state for under 30 days or less, an employer would not have to withhold. That's kind of been the general consensus. There's some states that are in themselves that have different thresholds, like in New York, for example, that has 14 days. But in general, 30 has been the one that we've seen the most. We've seen a few states move to that just in the past couple of years, like Indiana. There's been legislation introduced in Minnesota, and then Alabama, actually their bill passed and was signed by the governor on May 13th, which would provide for that 30 days or fewer withholding threshold for non-residents that travel into the state of Alabama. So that's good news to see. I'm glad to see progress on this front because the withholding rules, as travel has increased, as it's easier for companies to send people across state lines to do business, the withholding has been difficult to track, difficult to explain to employees. So it's nice to see we're getting into a little bit of uniformity there and hope to see more of that. I mentioned that there's some employment provisions in the one big beautiful bill, and the states are getting ready to either respond to those, or they're proposing bills that are very similar. For example, we've seen some states already put out no state income tax on tips bills. So know that those are out there. And as these things progress, we'll put more information out on it. A couple of just one-off items. Voters in Seattle approved a 5% payroll tax on compensation above $1 million. This is something that was voted on. 63% voted yes. This was called Proposition 1A out in Seattle. So look for that if you've got some highly compensated individuals out in Seattle, Washington. Another kind of case that we're watching kind of around the employment space is watching the Pennsylvania's jock tax case, which has now made it all the way to the Pennsylvania Supreme Court. The appeals court had struck down the city's 3% facilities fee. So it's something that I think a lot of folks just kind of have a passing interest in, but it's just an interesting case. And again, it's made it to the PA Supreme Court, so it's one that we're watching. And if you follow Pittsburgh sports, as I do in particular, you have an eye on that one. All right, and we have one last, we're going to wrap things up. We've got one last slide here with our CPE code word. What is your biggest state tax concern currently? Is it rates? personal corporate rates? Is it multi-state, understanding things outside of Ohio? What don't you know about what's out there? Do you not feel good about that? Maybe your knowledge of other states. Is it nexus, or municipal taxes, which we have not talked about today? Ohio municipal tax, um, which is a good thing. But yeah, but maybe it's still a concern for you and your business. Be interested to see. Okay, it's pretty evenly split, I would say. Yeah, almost a even split, with the rates being being the highest, but a pretty even split between the four things. Okay, John, you want to wrap up then? Just kind of wrap up everything that you've heard today with just some overall trends, and things that we're watching, that maybe weren't on our specific slides.
Sure. Well, for those of you that just answered, personal and corporate rates being the biggest concern, one of our observations is that for the most part, those rates seem to be coming down. We've talked about a number of states where that's happening, including Ohio. Now, that's not uniform. There are some states that are going the other way over the past couple of years, with Washington with their capital gains tax, Maryland, Sarah mentioned earlier, with their top rate going up, and then also sort of a millionaire's tax in Massachusetts recently, and then state of Maine also looking to increase their top rate right now. But on the whole, it seems to be a trend towards reductions. And then related to that, movements to flat income tax or even eliminating the income tax altogether. Certainly Ohio falls in the first part of that. Sarah also mentioned a number of states, moving to market-based sourcing recently, um, um, even on non-tangible personal property. So looking at things like services, intangibles, those sort of things, like purchaser's benefit type of analysis, that continues to be a movement as well. We will certainly see after the federal legislation that later this year, the next step follow on from that will be states looking at their codes, their state codes, and seeing where do they want to conform or not conform with what's going on at the federal level. Some states conform automatically unless they take action otherwise. Other states don't conform unless they affirmatively conform. So it's kind of across the board, but that'll be something to watch as well. States moving away from franchise taxes. On PTET, elective passenger returns and processes, states continue to refine those and make those hopefully more taxpayer friendly and easier to administer. And then the last bullet here, taxation of sports betting. That as sports betting has been legalized, sort of in many more states, the tax treatment of it obviously is an issue. In Governor DeWine's original proposed budget earlier this year, he proposed increasing the rate of tax from 20% to 40%. The House and Senate are not on board with that. They've got no proposal in there. Um, um, we don't have a bullet on here, but taxation of marijuana in states that have legalized that recently, that's taxation of that is obviously a new thing. Governor DeWine had also proposed to increase that tax from 10% to 20%. The House and Senate also did not go along with that. I think the concern there is more competitiveness with the rates around Ohio, which isn't really an issue on sports betting, but that the taxation of those activities is certainly another thing to watch as those industries become more familiar to DORs and legislators across the country. So that's what we see.
All right, thanks, John. I think that brings us to the end. Yeah, if you can't tell, lot going on right now, both at the state level and the federal level. We'll continue to monitor all of these different bills, and all of the things both at the federal and state level, and put out guidance on those. Again, if you have questions on anything you've heard today or about any specific states or tax types, feel free to reach out to us. And we appreciate your time, and have a good rest of the day. Thank you.